If we can just stay on the attack first, Mohamed, I want to ask you what the immediate impact is, given that we're not really seeing any reaction in oil markets in particular for the same reasons that Ziad just outlined, which is that, really this was not an attack that saw any damage, and also we're not seeing any impact in the Strait of Hormuz or anywhere else.
Yes, first off, in terms of the flow of physical oil, nothing has changed actually since the attacks that happened over the weekend. It's also important to mention that where oil price is trading right now, and that's quite an elevated level of oil prices. We're talking about the market closing above $90 per barrel on Friday. And if you compare that with previous instances where we've had geopolitical volatility in the Middle East, I mean, you take, for example, 1996, and we had some major upswings between Feb and April of that year. Oil had a knee-jerk reaction to the geopolitical events in the region, about 20% overnight. However, oil was trading around $40 to $45. So the base effect also matters. At the moment, from $90, is there room for oil to rally? Yes, there is, but it probably won't be as significant as oil trading much lower.
Our columnist Javier Blas was talking about $99.99 oil, a cent less than $100 a barrel. Is that what OPEC Plus countries are looking for, in the sense that they have the option to prolong those supply cuts into the second half of the year?
Yeah, I mean, look, I think in any case, we're probably heading towards a stronger oil performance in the second half of the year for a number of reasons. Yes, there is the geopolitical risk premium that could develop once again into oil prices. But you also have oil meeting a weaker dollar, a structurally weaker dollar, and the prospect of developed market central banks also embarking on the cutting cycle. So that is going to support oil demand in the second half of the year. You've also got the global refinery runs peaking in September. So I think there's a number of factors that would support stronger oil in the second half of the year. Whether we go to 90 or not, I don't have a strong conviction there. But, I think in the mid to high 80s, I think that's a fair assumption.
Is there a gap between market sentiment and geopolitical risk right now? It does feel like, the geopolitical risk premium is slowly coming out of this market.
Look, yesterday the Saudi Tadawul opened and closed actually 1% lower than, or less than 1%, actually 0.3% compared to the level it closed at before Eid. So there is a very clear signal, in my opinion, that the market is of the mood, stay calm and keep trading. The extent of selling also across the index was much less broad-based than it was on the first day of trading after the 7th of October attacks. So, and that in itself is indicative that the market doesn't necessarily see a systemic geopolitical risk event taking place. So I think there is a gap indeed between where the events are in the Middle East and where the market is headed.
Mohamed, before you go, I do want to ask you a little bit about your most recent work, which is on Egypt, and obviously other events have sort of taken precedence in the last few days and weeks. But before that, Egypt got this massive bailout, and things were looking up for Egypt. How do you see that economy faring over the next 6 to 12 months?
Look, I mean, Egypt fundamentally has two problems, or had two problems going into the IMF bailout and the funds that came from the UAE. It had a liquidity problem and it had a structural problem. I think the liquidity part has been addressed more or less, or at the very least contained. The structural problems remain. So if you're asking me about the time horizon, I think that's a very important question. If you're talking about the next 6 to 12 months, liquidity problems are contained. I think the market will continue to remain supported by the IMF bailout, by the UAE funds that will continue to flow, including another tranche in early May, hopefully. Beyond that, I think we need to see a clear signal from the government that it is serious this time about structural reforms, especially with regards to improving the level of public investments, participation from private sector, as well as the export potential for the country.